Welcome, everyone. Thank you so much for joining us. Nate and I are excited to have you and our awesome guests here today, Taylor and Daron. They're going to be speaking with us about the current mortgage lending environment we're in as far as what interest rates are doing and refinancing and how you guys can take advantage. It's going to be great. So we also welcome all of those of you who will be viewing the recording of this discussion over the next couple of weeks. We recognize that only a small percentage of people who requested to attend this could actually be here. So as this makes it your way, we also hope you find it valuable and helpful. So I'll just quickly introduce myself and our company, Keyrenter, here, and then have Nate, Taylor, and Daron introduce themselves so we can get started. My name is Ryland, and I'm the Client Success Manager here. I get to do a lot of the sales for our company, as well as some consulting here and there for clients and other people in our sphere. So if you ever need advice or resources in the realm of real estate, I'm your girl. I absolutely love working here at Keyrenter. For those of you who don't know who we are a full service property management company, and we offer stress-free rental investment experience with no surprises. Our services are for people who are investors and looking to make a passive income and believe in high value property management as the vehicle to growing wealth through real estate. So yeah, we look forward to connecting with you guys. I'm going to go ahead and have Nate, Taylor, and Daron introduce themselves, and then I just have a couple expectations.
Yeah, so just introducing myself, I'm the broker and co-founder of Keyrenter. We started the company back in 2007, and in 2014, we started the franchising process, and today we have about 45 offices across the country. And here I work with our team directly in our Salt Lake office, and we have a fantastic team. And grateful for all that they do for our clients and our residents, the experience that they're able to create for those that are involved in the business. It's just truly a joy to work with them. Also own rental property and have been investing in rentals since about 2006, and continue to strive to build my portfolio and do some great things in real estate and help those around me do the same thing. That's a little bit about myself. And why don't we hear from Taylor and give a brief introduction, and then Daron.
Okay. I'm Taylor.Wright. I've been with Security National for about 4 years. I've actually been in the mortgage world for a whole 4 years as well. I did study finance. I love working with people in the mortgage world, kind of just was a perfect fit for me. Right now we have a team of about 3 people that work with my clients. It was only a few short years ago where it was just myself, but I'm sure you've heard the demand in refinances and purchases, there's definitely been a need to grow the team. So I'm also a real estate investor myself. Got rental property and looking to grow my portfolio as well. So glad to be here.
Awesome, thanks. And Daron, I think you're muted there.
Yeah, there we go. You hear me now?
Yep.
Awesome. Well, great to be here with you, Daron LeBlanc with Guaranteed Rate. You can probably see that big logos behind me there. Been in the business for about 20 years. I love it. Guaranteed Rate is an incredible company, and I love working for them. 2019, NerdWallet named Guaranteed Rate the digital mortgage company of the year in all of the United States. And it's just a real simplified process for clients, from the application process all the way through uploading documents electronically. And that's some of the things I love, but extremely competitive from a rate standpoint, and just a huge support system that allows me to be extremely successful and love what I do. Yeah, crazy time for rates with refinancing. Once COVID hit, the 75 days following COVID, I closed as much business as I did in all of 2019 in 75 days. Thank goodness that's kind of tapered off. Taylor's shaking his head laughing. He knows exactly. I'm glad to see that taper off, and be able to help real estate agents more on the purchase side and not be so crazy with those refinances. The 12, 13-hour days I wasn't real excited about, but you do what you have to do to. My grandpa used to say, make hay when the sun shines. So good advice there for all of us in whatever we do. I'm glad to be here and be able to answer your questions today.
Awesome. Thank you, Daron, and thank you, Taylor. I've had the privilege of doing a transaction with both of you, and you have both been fantastic to work with. And we're happy to have you on. And this is going to be an interesting discussion. As we were talking as a team, in fact, I went to lunch with Colin just a couple weeks ago. We were talking about what would be a really interesting discussion right now, just in the environment that we're in. And he said, lending to interest rates, just the mortgage environment would be really important and relevant right now. And so you guys came to mind as far as some fantastic lenders and finance and mortgage experts to bring on. So appreciate you having on. I'd love to kick things off, you guys, with just having you share. Let's start with Daron. Share a little bit about the current lending environment. You mentioned already that it's been very busy, but let's talk about the demand for that. What's causing that, as well as what it is like on the purchase side compared to refinance, and just some general thoughts on that environment right now.
Crazy environment. Obviously, when COVID hit, there was huge swings in the financial market. 1,200, 2,000 point swings. On the Dow in the springtime. That's all kind of stabilized. But when that happened, it caused a real unrest in a couple of different areas in the financial markets. One was servicers. A lot of servicers were bleeding cash like crazy. I don't know if any of you knew this, but when you buy a home or you refinance a home, when a servicer takes over that servicing, it literally takes them 3 years of receiving that payment to break even from what they purchased that paper for. And so you got these servicers out there that had all of these transactions that have happened in the last 24 to 36 months, and every one of them, I shouldn't say everyone, but probably 70, 80% of people that bought homes in the last 2 years have refinanced or are refinancing. So servicers will get calls, margin calls, and a lot of them literally stepped aside. And from March all the way through about June, July, there were very few servicers out there that were even buying mortgage-backed securities. And so that could, if any of you tried or talked to your favorite lender at the time, there were a lot of companies that wouldn't even lock an interest rate until there was a clear to close. It just created so much upheaval. So, that's some of the fallout of COVID. The difference between 2008, can I talk about that for a little bit, Nate? The financial crisis. I think it's important to talk about. 2008, that crisis in 2008 was caused by the mortgage industry, by the real estate industry. You all remember some of the crazy loans, stated income. Oh, you just put down how much you make, or no income, no asset loans, all the craziness that caused that to happen. The financial crisis that followed took years to recover from. The difference between that financial crisis and the one we're in now is that was mortgage driven, that was real estate driven, that was all around that market. This crisis, the economy, was strong until COVID hit. And now we're back to printing trillions of dollars. The Fed's just spitting money out like crazy. It's 3 trillion. It'll probably be 5 or 6 trillion on the next go around, maybe 7. And that's all to try to buoy up or put money back into the economy. But it doesn't have anything to do with real estate. That the crumbling of that economy that happened with COVID. So what everybody, if you look at long term, when I say long term, I'm talking 18 months to 2 years. The Fed is saying they're not going to raise rates. There's not a direct correlation to the Fed saying rates are close to zero and they're going to stay there for a year and a half or 2 years. There's no direct correlation to actual mortgage interest rates. Indirectly, there is, though. The banks are getting their money super cheap. They're able to lend money at a lower rate. But this is my opinion, just based on what I've watched over the last couple of decades, is we're going to see rates low like they are now, with slight fluctuations here and there over the next year to year and a half. It's a great time to be in the business for all of us. The other point I wanted to make there was just when you look at really the ramifications of that long term. How is this going to be paid for? And that's the thing that none of us can predict and have no idea. Historically, and I know if you're looking at the polls, we got a vote next week, right? November 3rd. If you look at history, when there's an election and there's a Democrat that follows a Republican, I've literally seen the morning after an election where interest rates went up 0.5%. Literally from the day of election to the day after election, rates were 0.5% higher. I don't know if a Democrat's going to be in office. I don't think anybody can, even if the polls can predict what's going to happen in the results. But I also don't think we've never had a pandemic layering over an election. So with the elections right now, I'm not anticipating any blip in the radar, if you will, after the election on interest rates. I think we're still going to see really positive market to take advantage of the cheapest money I've ever seen in my lifetime. And it's an overused statement right now of historically low rates, but it's true. When I first bought my first house, I was paying 6.5% and thought that was, amazing. And now we're like, what? 6% is like a subprime loan, from back in the day. But anyway, yeah, that's a little bit of the market, a little bit of how I see things rolling out the next 12 to 18 months.
Yeah, so there's quite a few things to unpack there. I want to give Taylor an opportunity to kind of share his thoughts from his perspective of what the environment's looking like for you and your business and your clients, people you've been working with. You can relate that as well to, pre-COVID compared to now, as Daron shared some thoughts there. And then we'll dive a little bit further into, what the next 12 months is going to look like. We'll talk a little bit more about some of the challenges that we're facing with some of these refinances and new purchases. But go ahead, Taylor.
Okay. Yeah, I'd just like to kind of touch on your piece that you asked about with demand. Even before COVID, if we look at appreciation, not just in Utah, but across the whole nation, we've had super strong appreciation numbers that have just been increasing the values of our homes over the last couple of years. You add that with super low interest rates here in the last 6 months. There's just huge demand, not just for purchases because of the refinance or because of the low rates, but there are a whole lot of people that have actually, they're just in a good position to refinance because of the appreciation, because of the amount of equity. People that maybe bought their first home or bought their primary residence and have been paying mortgage insurance since they put 5 or 10% down. Well, now they can refinance that, remove the mortgage insurance, and lower their interest rate as well. So I feel like that's a huge contributor to the demand. If you look at the numbers for mortgage applications over the last, looking at the overall lending environment, a year or two ago, refinances were probably only 5 or 10% of the overall mortgage application volume. 90% of the mortgage applications were purchases. Right now, we're seeing about 66% of mortgage applications are refinances versus purchases. So it's just been a huge swing. We're seeing more refinances now than we are purchases, and both of those numbers are up. Purchases are up about 25% from last year, and refinances are up almost 100% as well. So it's just a huge increase in demand, kind of like you were saying.
Let me ask both of you. So on that point, interest rates last year were also very low, were they not? They were in the threes, at least from what I recall. You definitely have a better pulse on that. But do you think it's just the interest rate being slightly lower today than it was a year ago that's creating this demand for refinances? Or do you think there's other contributors to that swing from, you said 5%, and I don't know, Daron, if your experience is similar, but 5% all the way to 66%. Is it just that lower interest rate, or is there other factors here related to maybe just COVID and people not being sure what's going to happen over the next several years? What do you think there?
I think so. One thing that I've heard a lot lately with not necessarily investors, but people with their own homes is because of COVID, depending on their jobs, they've kind of had to be a little bit more conscious about budgeting themselves. And they've had more time on their hands and they're at home. So they're spending more time doing things that may make them think about refinancing or purchasing a new or upgrading or even down, if someone lost their job, they've also had to, buy something that was a little bit more affordable. But I think just kind of to quickly add, appreciation, I feel like is also a huge deal. People are in a position to get a good refinance because of the appreciation that we've seen over the last couple of years.
Yeah. Go ahead, Daron.
Yeah, adding, am I okay? I'm okay. I can't remember if I'm muted or muted. Adding to that, what we're seeing a lot of is people refinancing and changing the makeup of their home. Companies, everybody that I talk to professionally and is working from home. That's caused, especially when there's two incomes, two people working in the home, they have one office. People are refinancing, taking cash out and making their homes their offices. And there's many companies. I mean, I wouldn't want to be a commercial real estate agent right now with with people working from home and companies really changing the makeup of what they expect out of their employees to either work from home or be in the office. A lot of companies are going to allow, because productivity is so high, for most companies that are reporting how much more productive employees are at home. So that's another aspect to it, Nate, as far as where those refinances are coming from, is people needing to refinance and add on to their home or just really change the makeup to it.
Are quite a few of them cash out refis? People actually pulling cash. Are you guys seeing quite a bit of that?
For me, it's not a large percentage of it, but it's more than normal.
Same. I'd say the same as well.
Yeah, a couple weeks ago, I put out a video to our clients and list of people that subscribe to our videos, and I talked about just the rising prices and how these low interest rates, it's kind of like the perfect storm where we've got high demand, especially here in Utah, right? We've got high demand because so many people are leaving other states where there's a lot of governmental constrictions right now. And especially with COVID, people wanting to get out into some more areas where they're a little looser on COVID restrictions and also being able to work from home, cost of living is a little bit less, as well as the low interest rates. And just it's creating this uptick in values that we haven't seen in a long time, to where these low interest rates are just making it so people can afford to make ridiculous offers, right? I'm actually in the process of buying a new home for my family, and it was like, I mean, the list price doesn't matter anymore because we're just getting into these ridiculous numbers because people can afford more because of the interest rates. And I'm sure appraisers are trying to have to figure out how to manage that, right? And what they're going to do. What's your take on that? What's your perspective on just kind of this, people are just writing numbers on offers that have very little baseline based on list price right now?
It's not sustainable. I just don't see how this continue going the way it is, because appraisers are starting to have difficulties reaching those numbers. But what I'm saying is agents are writing the offer. They're saying, yeah, if you've lost on the last 4 bids, the only way you're going to get this house is if you'll pay extra. If it doesn't appraise for X, you're going to put $10,000 over than what it appraises for. It's just, I personally have never seen it. It's just insane. Part of what you're saying, Nate, is the move out of a lot of large cities, San Francisco, Seattle, Chicago, the big cities. People with all the civil unrest that's gone on gone on, they're leaving. You look at Manhattan, it's just insane that people are leaving by the droves. Utah is just getting hammered by a lot of, not from necessarily New York, but a lot of those people leaving those cities. And again, because companies are let people work from home, and it looks like that's going to go into the future, they can live where they want, as opposed to living near a corporate hub where they've had to live. So people are selling their homes like crazy in California. They're moving to Utah and Idaho and Montana and Oregon and Washington. This whole area of the West is seeing just an absolute craze in buying right now.
Why would you want to be anywhere else than here, right?
Exactly.
This is where we want to be. Taylor, what's your take on that?
No, yeah, I think with how low rates are, I feel like before when rates were kind of close to 4%, that was only about 2 years ago. Pretty close to 4%. People were more conscious about what their payment was going to be, just because rates were a little bit higher. So if they make an offer on a house, well, their payment's going to be a little bit higher than rent. I feel like now it's almost reverse. Rates are so low that someone can put $10,000 down on a house and have a payment that's actually less than what they're paying for rent. So I feel like that, and they just want to get into a house because rates are so low. So, kind of the same thing. I just don't know how it's sustainable. It's just crazy to me how, I have so many clients that week after week after week have a tough time just getting an offer accepted at the asking price, or even just a little bit above. It's just,
Yeah, my house that I'm buying, there were 9 competing offers. There were 4 competing escalation clauses, which means essentially that if there's a higher offer, your offer automatically goes above. And so you just have to, it's just a strange world. I've never had to compete in that sort of way for a property. I do want to change gears a little bit here, you guys. Let's talk about, for our real estate agent friends, investors, those that are buying, whether it's a primary residence or an investment property, but they're buying it as a business, right? Or they're self-employed. What are some of the challenges that you guys are seeing right now due to COVID-19? Because I know that, for example, I'm self-employed, and the process for me to buy a home is much different than it was, say, 2 years ago, just in terms of some of those restrictions. What are some of those challenges that you're seeing with self-employed business owners, investors coming in to buy properties and going through the lending process? Why don't we start with Taylor, and then we'll go to Daron.
So something that was added, at least for our company, Security National Mortgage, is we have to, and actually I think it was a blanket policy, is when someone is self-employed, we actually have to make sure within 10 days of closing, we have to make sure, first of all, that their doors are open, that they're making money, because obviously once COVID hit, everybody kind of shut their doors. So they wanted to make sure, okay, self-employed people, we want to make sure that you're still in business, basically. The other thing I think that's big is they want to see how you're doing. We want to see how you're doing this, so far this year. So I've had a couple of self-employed borrowers that did super well in 2018 and 2019. On their tax returns, they made a good amount of net income, but their profit and loss earlier this year, in June or July, they're halfway through the year, but they really only show about 0.25%, depending on obviously their business. They only really showed about 0.25% of income, whereas the years prior they were doing a lot better. So that I think is a big hurdle. I feel like, depending on your business. Obviously, those real estate agents hopefully are doing really well with this environment, but someone that is self-employed, that has their own business, that may be hurting, that is more has restaurants or somewhere where their doors were actually required to be shut, then it could be a tough deal to get a loan. That's what I'm trying to say. So it's just tough, because we do have to take into account how this year has been going. Whereas
it makes sense, right?
The last 2 years. Yeah, right.
It makes sense. I mean, they're trying to be cautious, making sure they're doing good loans. They don't want delinquent loans in the next 12 months, right? Daron, what are some of your thoughts there?
Yeah, same. Fannie and Freddie did put that out for everybody. Get a Fannie and Freddie loan, then you got to show either quarterly audited statements or bank statements to support the income, as well as a year-to-date profit and loss. So for me, what I've had to do on my end is, first thing I find out is their W-2, if they're self-employed. If self-employed, just got to set expectations right up front what they're going to experience. Because if they've done a loan before, it would have been a lot easier. So pre-qualification process is critical with someone self-employed, running the tax returns before they're out putting offers on houses. So.
Okay, very cool. Are there any other any other tips that you'd give to our realtor friends, and investors that are looking at buying either primary residence or investment property right now to help them get through the process smoother without as many surprises?
So one thing I might add is if your plan is to buy something in 2021, talk to your mortgage professional about your tax returns before filing. Just because obviously, if you have a donut shop and you sell $1 million worth of donuts, but you have $950,000 worth of expenses, us as a mortgage lender, we don't say you've made $1 million. We go off of the net income, the 50,000, right? So you do want to be careful in 2020 when you go to file your taxes, just with your expenses and your write-offs. Obviously, there's a lot of things that your accountant can do, but you do want to be careful because you do want to be able to qualify for that investment or for your next home in 2021, since we will be going off of your 2020 tax returns.
It's kind of a catch-22, right? It's like
you are paying more taxes.
Business owners, like, they have this goal of paying less taxes, right? Self-employed, right. You want to pay less taxes, but that could bite you in the butt if you're trying to buy property or refinance or get a loan, whatever it is. What are your thoughts, Daron, or any other tips you have to offer?
That's exactly right. I just ran into this with a client actually that called me up. He had been pre-qualified by another lender, told me what he was pre-qualified for, and in that conversation he shared that he didn't have enough income, so he filed an amended tax return. So that's the tip I'd like to share with you. If you're doing an amended tax return, you can't even start your application until 90 days after the amended tax return has been filed. Otherwise, the underwriter, they're not stupid, right? They're like, well, you've amended your tax return to show more income so you can qualify to buy this house. And they're fine with that, but it's 90 days following the amended tax return date of filing before you can even make application. So Taylor, you're right. You need to know ahead of time if you're planning on purchasing a home, write off less, know what those numbers are, make sure it's enough to qualify based on what your other debts that show on credit are. And if you have to file an amended return, you're going to be out a little bit before you can buy.
So I want to ask a question here for you guys. If we're looking at, say, our investment properties or even our primary residence, and you're talking to a client and they come to you and they ask, hey, how is it a good idea for me to refinance my property? And how can we know that it would be advantageous to refinance based on the closing costs that would be involved in that? Do you have kind of a rule of thumb that you give to some of your clients that are coming to you with that question? I mean, do the closing costs make it worth it? How long do they need to hold on to it? Some of those things.
So typically, your closing costs for an investment property are going to be anywhere from $2,500 to $4,000, and then escrows on top of that. Typically, I always talk to my clients. We just look, excluding escrows, your costs are the $2,500 to $4,000. Now, it usually takes about 2 to 3 years. If you're dropping your interest rate, let's say 0.5%, it usually takes about 2 to 3 years to make up the cost of that refinance. So obviously, it's dependent on your specific situation, but typically it's about 2 to 3 years. Now, the other thing you have to take into account is, are we changing the term? Are you going from a 30 to a 15 year? And then that opens up a whole nother world. But typically it's about 2 or 3 years. If you're going to keep the property, that's what we go for. It's a good idea to refinance.
Daron, do you have some thoughts there too?
I always, when I'm talking to someone who's about refinancing, I always ask what I call the crystal ball question. Because that's really the largest factor in whether it's going to be beneficial to refinance or not, is based on what you project in your life in this home. What does that look like? How long? And if it's, if it's like Taylor is saying, if it's less than 2 or 3 years, it's not worth doing just for a break even, but if it's going to be a long-term, if it's an investment property and you're keeping it and it's part of your retirement, then it's an easy decision. What I always look at is the life interest savings. So look at the loan now that you're in and what you're going to pay in life interest over the balance of the 27 years left on your loan, whatever that might be, versus lowering the interest rate and the life interest if you pay the minimum payment for the 15 or 30 years, whatever the term is. And then it's a mathematical decision. It's not emotional. I always tell people, if you want to brag about how low your rate is, I'll make you a t-shirt that says my rate's in the house. But at the end of the day, it's not about bragging what your rate is. It's really about, is it a fiscally responsible move to make? And it's just math, you know?
So using some basic math, let's say I save, $50 a month, right? And it's going to cost me, like you were saying, Taylor, say $3,000. I can just go 50 into 3,000. That's 60 months. So I want to make sure that I'm at least going to be in there. In that case, it's actually 5 years, right, to make up those closing costs. If I'm saving $50. So I think sometimes people jump into refinancing thinking, oh, I got to snag these better rates. But, to your points, both of you, how long are you going to have this property? Are you going to sell it in 2 years or 3 years? Then just hang on to what you got if you're not making up that difference. So thanks, you guys. This is a great place to answer a question as well. We're going to have a little bit of Q&A here in about 5-10 minutes, maybe 10 minutes. But on the subject of refinancing, our friend Brian asked a question, and we got some of these questions through the registration process. There's a place for people to put in some questions. And he asked, he said he'd be interested in hearing about the best way to get a loan from a first existing free and clear income property. He said this loan would be used to help finance a second income property while still keeping the first existing income property. Why don't we start with Daron and then go to Taylor, just share some thoughts on how to go about doing that. It sounds like there's some options.
Well, it would be like any other refinance at that point. It wasn't free and clear. It would be a cash out refinance based on, depending on what, there are limitations on investment properties to cash out. It's not the same as a owner occupied. So depending on credit score, that's going to be a factor there on the cash out because there's fairly significant hits on cash out. I do know, at least I believe I know that on home equity loans, most credit unions and banks are not doing home equity loans on an investment property. But I have had people take an investment property, a home equity loan out on their primary and use that for down payment for their investment property.
Now, is that the same as a home equity line of credit? What's the difference between a loan and a line of credit? And are you seeing that banks and credit unions are doing lines of credit, maybe in as opposed to loans?
Yeah, I'm talking about home equity line of credit.
Oh, you are? Okay.
For on a primary, but I don't know of any Taylor. Do you know of anybody that's doing it on investment?
Not on investments.
So that's the cheapest way to do it if you can do it on your primary, because there's virtually no closing cost if you keep the home equity loan for most banks are 2 or 3 years. They don't charge you any closing costs. It doesn't. I don't make money doing that, but if they've got that capability, it's better than refinancing their entire primary, or maybe even better than taking the cash out hit on an investment property that they would have.
Any other thoughts there, Taylor?
Not on that point. I guess I could just add that I've actually had a couple investors come to me for doing exactly what we were talking about, doing a cash out on one of their investment properties and pulling that cash. They were still able to get, it was basically a 3% interest rate, which was lower than they originally had, but they also used that cash to buy another investment property. So they ended up taking their one investment that had like a 4% interest rate. They lowered the interest rate on that one, and then at the same time used the cash that they pulled out and bought another property. So there's definitely, with how, depending on what your financing, situation is on your rentals, there's definitely some options if you're wanting to expand your portfolio. Just because with how low rates are, you can use some equity to purchase another unit if it's in your best interest. So,
And Daron, you're sharing some of the restrictions or challenges with investment property compared to primary. Is that because of the COVID environment that we're in, or does that predate that?
Predates that. Yeah.
Okay.
They look at risk assessment on every type of loan. The general rule is if it's an owner occupied, it's the risk assessment on a loan like that is just going to be credit score and loan to value. When you add the component of an investment property, that's considered a much higher risk than owner occupied. If you look back to 2008, so many people had been buying tons of investment properties. Rents fell, everything else was going on, and they kept making their payment on their primary because that's where they live. And the investment properties, a lot of investment properties went to foreclosure because they weren't making the payments. So that's why they look at things differently on an investment property versus owner occupied. It's simply the risk to the investor.
Interesting. Okay, very good. Well, Brian, I hope that helps answer the question. You guys are welcome to put any follow-up questions in the chat if you'd like. I want to talk about just this discussion that Daron, you kind of chimed in on what you see happening over the next, 12 months or so. And you mentioned that you see that rates will remain low, maybe slightly fluctuate over the next 12 months. Let's talk about that for a few more minutes. What gives you that impression that we're not going to see, some dramatic hikes, in rates? Because there is some talk and speculation going on saying, hey, if we get, depending on the election, we're going to see some spikes, or because of the economy requiring and forcing the rates up in order to recover, we're going to see some spikes in rates. What's giving you that impression that they're going to stay low? And just for the record, I actually agree with you as well. So
where I'm coming from there is just what the Fed Reserve Board and the chair is saying. They're just saying we can't raise rates. We're not going to touch the rates for a good period of time. And again, not a direct correlation, but an indirect correlation that I think will keep things down. Will there be some spikes here and there? I think there probably could be, just based on a vaccine coming out and the market rallies. When I say the market rallies, mortgage-backed securities are the primary instrument that you can watch to predict where rates are going to be that particular day. Historically, a lot of people have always used the 10-year bond, but that's been so unpredictable through COVID that it's really not a good indicator. But, the other thing I would add to your question there, Nate, is I don't think either one of these presidents is going to change the economic forecast, meaning I don't think they're going to start saying we've got to increase interest rates. If you look what Trump's been doing the entire 4 years he's been in, has been beating up Powell. I mean, he calls him names and just is hammering on Powell to lower the rates even more, and he did. We're down next to zero. In addition to that, you've seen what maybe if you watch national or worldwide news, you've seen that in the EU over there in Europe, they've been dealing with negative interest rates. I've always said I don't think this country will ever do that, but I'm not so sure. Negative interest rates, what does that even mean? I had to study that. I'm like, what's a negative interest rate? They're paying people to borrow money from the bank. They're paying people. So, I mean, I think, quite honestly, before we see increased interest rates, we might see that. But at the very least, I think we'll see, rates near zero from the bank, from the Fed to the banks, and it's just going to keep our rates low.
Thoughts, Taylor?
No, yeah, I think like Daron was saying, the Fed has said that they're not going to raise rates until 2021. I think is the latest that they've said, and that's just to help us, our economy recover. Obviously, mortgage rates are independent from the Fed rate, but with them basically saying that, it sounds like they expect us to take 12 to 18 months to recover, which will hopefully inflation will stay around 2%. That way rates don't go up, because the big indicator, I guess, for rates as a whole is usually inflation. So as our economy starts to recover and inflation gets where it needs to be and starts to go high, as our economy starts to boom, that's when we'll start to see rates go up a little bit. But kind of to your guys' points, I don't think it's going to happen for the next 12 to 18 months either.
And without a crystal ball, right, we can't see, but what's your impression? I mean, how long can we sustain this as a country? You know, and I know that's a loaded question, and we're not necessarily economists here. We might dabble and definitely have some ties in there, but what do you guys think? I mean, how long can this go on?
Wow, that is a question I didn't think we could do what we've done.
I know we're already beyond that point, right?
The Fed and the money that they printed, $3-4 trillion heading towards 7-8 if the next Senate and Congress passes this next COVID package. I mean, it's just what we will have done in a 12-month period will be more than we've done in the last 20 years from quantitative easing or anything else from the Fed. I'm just speechless. It's not healthy, obviously, for our economy long term, but I don't think we'll have a president that's willing to come in and put our country into a depression, which is what they have to do. They have to stop printing money. I don't see anybody with enough backbone to step in there for 4 years and put our country into a depression and make us pay for our sins, so to speak, or our crimes, if you want to call it that. It's so. To have something positive to say, I would say invest in real estate, gold, and I don't know what you want to know, my third one, but cryptocurrency. Store of value is really where it's at. You guys that are investing in real estate are smart and continue to do that.
Great. Taylor, any thoughts there?
I was just trying to think what to say, but I think, if over these next 12 to 18 months, if rates don't go up, I'm just interested to see what happens with appreciation, because we've also already seen some huge numbers with appreciation. So kind of to Daron's same point, if you can invest in real estate now with low interest rates, I feel like we're still going to continue to see this appreciation boom, just simply because something's got to make demand slow down, or kind of increase supply, I guess. So I feel like if you can get in some units right now, it's going to be, you're going to see some huge value increase over the next little bit, just because I feel like appreciation is going to continue to be strong. So.
Great insight, you guys. I mean, my final question was going to be how we can take advantage, but you guys both just shared some thoughts as far as investing and putting additional capital into real estate, take advantage of low rates. Appreciate you both. Let's jump into some questions here. Ryland, why don't you jump in here and share some questions? And if you have questions as you're attending live here, feel free to put those in the chat. Looks like we had one from Colin. And Ryland, why don't you take that portion here?
How can an investor qualify for an appraiser waiver? Appraisal waiver.
You want to take that, Taylor, or you want me to?
You go for it.
All right. Appraisal waivers are going to be property specific first and credit specific second. So when we run an AUS or an automated underwriting system with Fannie or Freddie, it's either going to say yay or nay to an appraisal waiver. We don't have any control over it. And it's all based on Fannie and Freddie's database of what similar properties. There's an algorithm that they have that somebody really smart could probably reverse engineer if they wanted to. But I get appraisal waivers probably 9 times out of 10 when there's 20% down, but on owner occupied, not as much on investment properties, even with 20% down.
Yep, I have the same experience. So Daron can probably attest to this, but we've been getting a huge increase in the amount of appraisal waivers that we've been able to get, just due to the demand in refinances and purchases. So we've seen a whole lot of appraisal waivers. I've seen it as high as 90% loan to value. Not much higher than that. I don't think I've gotten one much higher than that. But if you at least have 10% equity on a refinance, you have a chance of getting an appraisal waiver. Kind of like Daron was saying, it just depends on what Fannie and Freddie kind of have in their database for the potential value for your house. So,
what's the advantage of having the appraisal waived?
It just
why would someone
the
want
closing
that?
costs essentially. It drops the need of having to order an appraisal, which is anywhere from $400 to $600. And then also it saves time. Having an appraisal waiver cuts down about 2 weeks, and just simply because appraisals are taking a whole lot longer now than they were before because of the amount of units that we're doing. So,
do you think that those waivers are artificially inflating the market? Where if an appraisal is not required, and then the next week, and that closes, and the next week an appraisal goes out, and they use that as a comparable where there was not an appraisal done. Do you think that could be contributing to some of these spikes in values?
I don't think so, because Utah is a privacy state, so a private sale that happens, or even an MLS sale that happens without an appraisal. So you're suggesting, Nate, that possibly if it's $20,000 over, the truth of the matter is you're likely not going to get an appraisal waiver on a property that's overinflated, because Fannie and Freddie does use a database of sales that they've logged in that particular area. So I don't think it's going to have an impact personally.
I'll give you an example. So the house I'm buying, one of the conditions is I had to waive the appraisal contingency. And so what I did is I went to the lender and said, "Hey, can we request a waiver?" And I don't think that they could really request it, but we got it waived because I'm putting like 30% down. And so it got waived, but the price is well over ask price. And so I think in that example, where we're going to be recording the sale price, there was no appraisal done. I don't know. It makes me wonder.
You might be right.
Sorry, go ahead, Daron.
I just say you might be right in a case like that. It could have some impact.
Yeah, and I'd be interested to see if Fannie or Freddie has something that logs in their back system that says, that kind of takes that into account. Yours is being sold for over asking price. Well, maybe they don't take that into account necessarily for for future properties. I don't know.
Do you think that, not to, beat a dead horse here, that's a horrible expression, but do you think that appraisal, lenders or appraisal management groups and the underwriters are willing to have appraisals waived because of the demand, because appraisers are so backed up? I mean, Daron, you and I did a transaction recently where, it took weeks to get that appraisal done. And I wonder if they look at those situations and say, "Hey, they're putting enough down. We just don't have the bandwidth to do this appraisal. Let's just waive it." Is there any correlation there, you think?
I don't think there's any correlation at all. I don't think Freddie and Fannie even pay attention to that. And the lenders don't make the decision anyway. Fannie and Freddie doesn't care how busy appraisers are. If they feel like there's one needed, they'll ask for one, period.
Good point.
But I will say that when COVID hit, the owner of our company actually has a couple of, Fannie and Freddie heads in his cell phone. And they did talk about relaxing their standards on appraisal waivers to help through COVID because of the, having to go into homes and, with the fear of the spread of disease. So there was some relaxing from both Fannie and Freddie this spring, and it's still continued.
Interesting. Ryland, is there another question you want to jump into here?
Yeah, we've got another one that, definitely Taylor and Daron can touch on, but I think this might be a good one for you, Nate. What impact do these low rates have on the rental market with tenant demand for rentals?
Yeah, so I'll jump in here, and then if Taylor and Daron have some thoughts too. Demand for rentals from the tenant side definitely can, I would say, increase, and in many instances as well, decrease. It depends on the credit profile of that resident. For example, if someone has very high credit score, and they can take advantage of these low rates, and they have the down payment requirement, most often they're going to be jumping into buying a home. Taylor touched on this before, where if we've got rental values that are below the threshold of those mortgage rates for the same type of property, far below that, they're going to most likely rent in those situations. But they tend to catch up with each other over time. As we see values increasing in the home market or home sales, we also see an uptick in rental values, and that's also caused by demand and many other things. We look at kind of the income equation here, and we see that as incomes are not catching up with rental prices and home values, they start to stagnate a little bit, and it drives down those rental prices. And as that happens, we'll continue to see an increase in demand and also an increase in the amount of tenants coming in. Now, if interest rates were to go up significantly, I think we'll see more homes sitting on the market. We'll also see more people getting out of their properties, maybe due to foreclosure or other situations, and fueling more demand for rentals. But overall, housing is in high demand, both on the rental side and on the sell side, as we've touched on here today. And interest rates has a play there, but I think it's more of the affordability side of where people are at. What are you guys' thoughts? Any differing thoughts or similar thoughts there?
I think you're right, and I've had a couple investors come to me and just basically the whole reason that they wanted to refinance was obviously increase their cash flow, but also increase flexibility. Whereas into what they're willing to accept in terms of their rental income for a certain property, just in case the demand for rents went down. So they were able to lower their rental expense or their investment property expense, their mortgage payment, $100. Well, that gives them $100 worth of wiggle room if when they need to find tenants to rent out, if that makes sense.
Awesome, thanks. Anything, Daron, to add?
Yeah, the one thing I would share that is what I see happening in the Utah market is there's a lot of employers that are relocating clients here in Utah. And a lot of them don't want to buy right away because they want to make sure they live in an area after they've lived here for a bit and researched the geography. So there's a high demand right now for corporate rent. So I know several large employers up in the Davis County area, and there are several in the Utah County area where it's hard to find rents. I've got a couple of real estate agents that have not invested in real estate before that are out looking for duplexes and properties to buy for that express reason.
Very cool. Hey, well, thank you both for taking some time here, and appreciate your wealth of knowledge and your insights just related to lending and mortgages and refinancing and rates and all that stuff. Very insightful. I've definitely learned quite a few things here today. Grateful for everyone who's been on today and those who will be watching the recording of this. Ryland, I'll turn it over to you to wrap things up and we'll close it out.
All right, so as you can see here, I just have pulled up our contact info screen here again. Thank you again, as just to parrot Nate there. Thanks again for joining us. It's so good to see all of you and some of you who, we've been in contact with and we're close with. Yeah, feel free to reach out to me if you guys ever need anything. I'm here to help. And then, of course, Taylor and Daron, if, you guys have questions further on these topics and if they can help you out with anything as well. But yeah, I hope you all have a really great day and we will see you next time.
Thanks everyone.
Thanks for the opportunity.
You guys.
Thank you. Have a good one.